The topic for discussion today is financial options and applications in corporate finance. It's a very interesting area, and we're just getting into the real fun part of finance, and we are just coming towards the end of the semester. So hopefully, this chapter and another chapter, you'd be able to take away some of the advanced concepts in finance. This being one, which is of financial options. We've covered the basic premise of options, so we'll go over some of the basics, looking at the terminology, option price relationships, and I'm going to demonstrate an actual valuation based on Black-Scholes option pricing. And then we'll see about put-call parity relationship. So again, looking at the big picture, the value of a stock option is basically a function of the expected dividends which are going to be received from the stock, investing in the stock, discounted by a certain discount rate. But in this case, what you have is an assessment. What would you be willing to pay for this stock, for a future period of time? So you are buying all right, we got dropped a little bit, so in case we get dropped a lot, I'm going to try and use the hard wire instead of the wireless access here. I don't know what happens, whenever we have change of weather, it starts dropping. It's got something to do with the weather. I don't know, the wireless access or the internet. So what's a financial option? Like we've covered in the intro chapter, the financial option is a contract which gives its holder the right but not the obligation to buy or sell an asset at some predetermined price within a specified period of time. So, a couple of characteristics that you got to understand clearly is that it is a contract. But to the buyer, it gives the right but not the obligation. So if the buyer wants, they can forego, buying of whatever option has been purchased, or to sell any asset at some predetermined price within specified period of time. Now, in case of American option, there are two types of options. I didn't see this distinction provided in the textbook. We've got two types of options. One is an American option, as in the country, and this may be exercised by the buyer of the option anytime leading to the expiry date. That is an American option. In case of European option, it may be exercised only on the expiry date. So, European as in the continent. So there are two types of options in case, you'd be interested in knowing, how they are different. So this is one of the major difference between the two. American option is an option where you can exercise at any time leading up to the expiry date. European option can be exercised only on the expiry date. So you're buying the option to buy or sell on one specific date for European option. In case of American, you can buy within that window anytime you want, buy or sell.
European option trading is like the American option during, how the price of the option goes up and down.
Yeah, it'll be traded in the same way, but the exercise, difference is there.
If in Europe I bought a share for any company, so I need to like it will be specified that we can only sell this.
No, it's not the share, it's the option. You're not buying the share, you're buying the option to buy the share. So you're buying the right to buy the share. So for example, it's a contract. So for example, the buyer would buy the option to buy the share within a specified period of time for a preset price which will expire on a certain date. So the good thing about American option is if you don't want, you will not exercise it. For example, if your option buying price is 25 and the selling price of the share in the market is 23, you won't exercise it. Why would you pay $2 more when you can just go out in the market and buy at 23, which is cheaper? So here you will forego your exercise, right? But let's say if in the market the share is selling at $20, I'm sorry, it's selling at $27, then you will exercise because your buying right gives you to buy the share at 25, whereas it's selling at 27, so you get that $2 advantage. I mean, sometimes, the insurance, health insurance or automobile insurance, they're compared to as an option. For example, when you buy an insurance for your automobile, you pay a premium. That's a transaction cost. So it gives you the right to exercise a claim in case your automobile is an accident, right? But if your automobile is not in an accident, you will not exercise that option. Or in certain situations, for example, if your deductible is $500, that is, you must meet your deductible before the insurance company can pay the amount, and the repair bill is $200. You will not report that accident to your insurance company. No, your deductible is more than the repair bill. So an insurance is also like an option, right? You will only exercise if you need to exercise. So what is the single most important characteristics of an option? Now this is American option, not European. It does not obligate. I mean, it's also in European because you don't have to buy it if you don't want to. It does not obligate its owner to take any action. So if you don't want, you don't have to exercise your option. The most you will forego is what? The transaction cost, the price that you paid to buy the option. It merely gives the owner the right to buy or sell an asset. Now, some of the terminologies for an option, you can have a call option. This is an option to buy a specified number of shares of security within some future period. That's why it's called call. When you call, you're bringing it in, right? That's buying. Put is to sell. So this would give you the right to sell, but you're not obliged to sell if you don't want to. A specified number of shares of security within some future period. Now, why would you have option in the first place? Besides the fact that you may use it as a speculative tool to make money, but it is to create some stability in the market. I mean, options are not a new feature. They have been in existence for hundreds of years. Option really started to bring stability in the market so that you get some benchmark pricing. For example, especially in commodities. So for example, if a farmer is going to grow wheat and the farmer is able to have a put option, that is, it gives the farmer some right to sell at a specified price at a future date, the farmer knows exactly how much money he would be able to make, by growing that much of wheat. So irrespective of what the price of the wheat is in the market at the day he goes to sell, if he has a this put option, then the farmer would be able to sell it at that price. So there is a benchmark rate which the market can follow. So it leads the pricing. Does it make sense? On the other hand, imagine if there were no options and rates changed on a daily basis and the farmer didn't engage in any option. Then the farmer would have to rely on what price he or she would take, the stock to the market. Whatever the spot price would be, he or she would be forced to sell at that price. It could be in his or her advantage. It may not be in advantage. So what options do is they provide some insurance. They provide some stability in the market. But nowadays, options have been used, for a variety of different things, which is also for speculation. That is to, take a position in the market in anticipation of making money. Because what happens at the expiration date of the option is they don't actually, transfer the wheat. For example, if you got option on 100 bales of wheat, they're not actually going to bring 100 bales of wheat. What will really change hands would be the difference in pricing. So for example, if the farmer, or let's say anyone, took an option to sell wheat at $25 a bale. I'm just making it up. And on that day, the spot price is $22. And the farmer says, well, yes, I want to exercise this option to sell. So there will be no exchange of wheat. What will happen is the buyer of this option would simply pay the seller $3 per bale. And that would nullify the option. I mean, options normally don't reach that exercise point. That's the reason why options never reach the exercise point. They would be exercised just a little bit before exercise point so that they're nullified. So no physical exchange of products have to be there. You understand? So you'd really find any options really being exercised on that exercise date. Well, moving on, you got the strike price or the exercise price, the price stated in the option contract at which the security can be bought or sold. So having a strike price will give you some assurance that you can buy or sell at that price in the future date. Expiration date, the last date the option can be exercised. Now, looking at what can be the exercise value, the value of call option, if it were exercised today. Now, follow me in this discussion carefully. When you exercise this option, there can only be two outcomes. One would be 0, the value would be 0. What would be the situation when the exercise value is 0 in case you are exercising it today? In case of buying, let's say this is a buy position. If it's not in your favor and you don't exercise it, then the value of that option is 0. It's expired. It'll expire and you will not gain anything, right? On the other hand, the other possibility would be the case where the current stock price is greater than the strike price. So for example, if the current stock price is $28 and the strike price is 25, then in this second possibility, the value will be $3. So what would be the maximum of the two between 0 and 3? It's 3, right? So in this case, the exercise value would be $3. So the exercise value is 0 if the stock price is less than the strike price. For example, if the stock price is $20 and the strike price is 25, would you exercise this option if you're buying? It doesn't make sense, because that means you want to lose $5 when you can just go out in the market and buy it at $20. So in this case, the value of the option is $0. Option price, the market price of the option contract. So how would you find the option price? Option price is the secondary, selling price, because options can be sold in the secondary market. And that would come from the difference between, the current stock price minus the strike price. That is, what is the value of the option? The greater the difference, more value it will hold. Time value, option price minus the exercise value. It is the additional value because the option has remaining time until it expires. Because, you got, let's say this is today and the option is for 3 months. So this is the expiry date. So the time will also have value notation on this option, because it holds more value when you're further away from expiry. I mean, you can tend to see what the probability of its maximum value will be when you're very close to the expiry. For example, if the difference is not in your favor, then you know that this will expire as a 0 value option. For example, in any football game or baseball game, in the first quarter, you have a lot of time to make up for the score. But when you've reached at the last quarter and you just have 5 minutes left, and one team is, let's say, 25, the other one is 10, you know for sure that that the stakes are against the second team, that the first team will definitely win, or more likely win this game. Same thing happens, in the case of options. So when there is more time remaining, there is more time to catch up. But when the option reaches its expiry, then you know with certain possibility that it'll expire, and you know the outcome. So people will just not pay too much money for that option, because they know that this is probably going to be not in their favor, and only some luck or some insider information or something radical happening with the company could really change the position of this option. And this, remember the conspiracy theories around 9/11? That suddenly before 9/11, there were some major positions of options taken up against the airline companies. I mean, why would somebody buy major position or buy options to sell stocks of airline companies before 9/11, a day before 9/11? That rose, those conspiracy theories that they knew something was going to happen. I mean, if somebody's buying major options to sell stocks of an airline company just a day before 9/11, what could be the reason? So that was one of the, reasons that gave fuel to, that conspiracy theory that people knew about, or some companies or some investors knew about the event even before it had happened. So option terminology continued. Writing a call option. For every new option, there is an investor who writes the option, because in this case, the transaction would have to have two parties. One would be the writer, one would be the buyer. Like in case of insurance company, there is an insurance underwriter and then the buyer of the insurance, if you want insurance. On the other hand, if you recall, we also discussed about forward contracts. Sometimes you get confused between options and forward contracts. Forward contracts are organized and structured. They basically are in a standard format in terms of the value, in terms of expiry, and in terms of how they are traded. Normally, forward contracts would be traded on an exchange, whereas options can be done between two parties. I mean, you don't even need to bring a third party. I mean, a simple handshake would also be an option. If you trust the other party, you could say, hey, let's handshake, or let's just write on a piece of paper that these are going to be the terms for this option, and that is an option. So that can be customized. In case of option, it can be customized to meet the requirements. For example, automobile insurance. Are they standard insurance? I mean, does everyone get the same sort of insurance? No. They are written specifically customized to everybody's need. Somebody may need more insurance than the other. So that is an example of an option. Do all insurance expire on one date? No, they basically expire on a customized date. So that is a difference between option and a forward. So try to keep that in mind as you compare them to forward contracts. So in this case, a writer creates a contract, sells it to another investor, and must fulfill option contract if exercised. If you go through an organized exchange, or if you go through a third party, it does help in holding the other person to abide by the contract. But even otherwise, I mean, if you simply were to write it on a piece of paper which is notarized, or which has gone through legal process, that is also an option. For example, the writer of a call must be prepared to sell a share of stock to investor who owns the call in case the option is exercised, or be ready to present the difference in money in case the option is exercised. Students online, everyone clear so far? Okay, moving further, let's look at different types of options. The covered option is a call option written against stock held in investor's portfolio. Now, this is done more for hedging situation. For example, if you're worried about the price of the stocks that you're currently holding falling in future time, you could write a put option, which is to sell, right to sell. And imagine if investors, had put options to cover their investments before the last financial crisis, they could have protected the fall in their portfolio's net worth or investment. A naked or uncovered option is an option written without the stock to back it up, and this is done merely or mostly for speculative reasons. That is to engage in the market as a speculator, that is to make money from buying or selling of options. But the first one is normally done for hedging purposes, that is to protect your portfolio investment. So what is in the money call? It's a call whose strike price is less than the current price of the underlying stock, hence the term in the money. So you would be in the money. For example, if the current price is $27 and your exercise price or the strike price is 25, your net gain is possibly a $2 per share. So you are in the money. Out of the money, a call option whose strike price exceeds the current stock price, which is the reverse. In case, let's say, the current stock price is 25, your exercise price, let's say, is 27, then you are out of the money, because you are not going to exercise this option to buy, because you have a potential loss of $2 in this case. You will let the option expire, right? LEAPs are long-term equity anticipation securities that are similar to conventional options, except that they are long-term options with maturities of up to 2.5 years. I mean, now we extending them for 2.5 years. So those are referred to as leaps, because you are leaping further ahead. So let's take an example here. Let's say and the best thing to do would be to follow this in Excel worksheet so I can demonstrate. All right, students online, can you view the Excel worksheet? Students online, okay, thanks for confirming. And what I'm doing is I'm just copying the data that's given on slide number 14. You got the stock price and then the call option price. Remember, the call option price would be the price of the option, and you got $3, 7.5, 12, 16.5. We got 21 and 25.5. And for all of the cases, the strike price is $25. So, and it's intuitive. Look at, for example, when the stock price is 25 and the strike price is 25, you really don't have too much of room to make money. So your call option price is $3. That's the transaction cost. But on the other hand, if the stock price is 50 and your strike price is 25, you potentially have a $25 possibility to make as of today, which could increase in future time. At that time, the call option price is $25.50, just to kind of give you those two extreme ends. So what is then the exercise value? And in this case, the exercise value would be the price of stock minus the strike price. So if you were to exercise your option today, your exercise value is going to be 0, because the stock price is 25, strike price is 25, you will not make anything. On the other hand, I just need to copy this down. You can see the exercise value go up as the stock price is going up. The strike price is the same. Now,
stock price is So 250 would be the time premium.
250 will be the time premium. That's the premium you're paying. Like in insurance, you have the premium you pay. So let's add the market price of option. That is, if you were to buy or sell this option in the market, what would be its value? Okay, my computer just gone a little slow, so the students are wondering. All right, so this would be the call option price, which we had just covered. So $3, $7.50, $12, $16.50, $21, and $25.50. So this is the price at which you can buy or sell this option in the market. All right. Then what we add to this is the time value, which is the convenience charge. Yes, same as call option price. So time value would be the market price of option minus the exercise value. So in this case, what you have is simply the market price minus the value of the option, the exercise value of the option. So the difference is what? Difference is the convenience charge that the holder of the option is charging. It's like the storage cost. In case, let's say a person is storing wheat and it's sold at certain price, this is the price for storing. I'm just giving a very simple example. It's basically holding the option. This is the convenience charge. And then, so it's a very simple calculation. Let me go back to show you a very interesting. So this is going to be this here. Let's see if I can get. I think I got it wrong. This should have been. No, this should be the other way around. Like it should be inverted like that. So switch over. No, I'm going to just leave it. I'm going to show you the graph on the PowerPoint, and I'll play around with it to show you if I can create that graph. So there you go. So you got the call time value diagram. You got the option value here on this axis, and then the stock price. And you can see that the market price of the option is greater than the exercise value. So you are in the money. Right, see this, the difference? Yeah, by holding the option, by selling it, if you're the seller, not the buyer. So option time value versus exercise value. The time value, which is option price less its exercise value, declines as the stock price increases. This is due to declining degree of leverage provided by option as underlying stock prices increase and the greater loss potential of option at higher option price. So as the underlying stock price increases, if you are the seller of the option, your possibility to make money decreases, right? On the call option, not on the put option. Let's look at the valuation in binomial model situation. So this one again, what you're trying to look at are two states. And again, it'll be good, if I can show you in Excel, but just to give you a reading of what the scenario is, you got stock assumptions. Current price of the stock is $27, and you are assessing that in 6 months the stock can either go up by a factor of 1.41 or it can go down by a factor of 0.71. Other information that's given to us is expiration happens in 6 months, which is half a year, which is 0.5 years. Exercise price is $25, and the risk-free rate, which you can borrow in the market from, is 6%. So let's work this out in Excel. All right, so the current stock price is equal to $27, right? Now in 6 months, it can either go up by a factor of 1.41, which is going to be 27 multiplied with 1.41. That's $38.07. Or it can go down by a factor of 0.71. So it will be 27 multiplied by 0.71. What happened? 27 multiplied by 0.71. So that's $19.17. So these are the two possibilities. Now, option payoff which is the value the option payoff value would be the maximum between the two, that is 0, or the price of the option minus the exercise or the strike price. So in this case, what would be the option payoff? This is going to be max of price of up factor, which is going to be 27 multiplied with 1.41. Either the 0 or 27 multiplied by 1.41, and then minus the strike price, which is 27. Okay. What happened? Oh, the strike price is 25. I'm sorry. That's my mistake. That's why. Okay, now we have correct. Let me add that here. This is given in the slide number 21. The strike price is $25. $27 is the current stock price. Okay, now it makes sense. Okay, so this is ending up stock price, and if that happens, if that possibility were to happen, what would be the option payoff, which is CU. Okay, if on the other hand, if you get the down possibility that it may go down by a factor of 0.71, then the ending down stock price will be $19.17. In this case, the option payoff, which is going to be CD, which is in the case of down. I mean, we can use max, but we know it's going to be 0 because you're not going to exercise this option, but we can just follow the formula, which is going to be max of 0 or the price, which is 27 multiplied with 0.71, which is the down factor, minus the strike price, which is 25. So in this case, the value is 0. You will not exercise. Option payoff is 0. Okay, students online, clear? I mean, it's just the understanding part. The calculation is not that difficult. It's just the understanding part that you need to follow. And I think I've gone step by step, so it shouldn't be a problem. You know, you got, let me add this to it. Yeah, this is a single period, yes. Okay, now it should be clear. You know, you got, this is case 1, this is case 2, and you got, you know, this follow-up. So this should now be clear. This is what's happening. All right. So in this case, obviously, the value is 0. You will not exercise. In this case, yes, you will exercise, and the value is going to be 13.07. The option payoff will be 13.07. Okay. So this is exactly what we have calculated. I mean, it's the same thing that we have done. Create portfolio by writing one option and buying n number of shares of stock. So how would you create that portfolio so that you can, you know, create a sort of a hedge? In this case, if the stock went up, you would have n number of stock multiplied with the price of the stock multiplied with the up factor minus the payoff value. And same thing, if the stock went down, you would have those n number of shares multiplied with the price of the stock multiplied with a down factor minus the payoff if the share went, I mean, if the payoff with a down factor. So to create a hedge portfolio with a riskless payoff, you would set payoffs for up and down equal, solve for the number of shares, and that would give you NS, which is the number of shares you would have to keep to create that perfect, you know, portfolio that's going to hedge your situation. So this would be up payoff minus the down payoff divided by the price of up factor, the price meaning the price of the share, multiplied by up factor minus the down factor. So from the information that's been given to us, what is CU? The payoff in case there's up factor. Remember, we just calculated it was max of this one here. So max of 0 comma PU minus X, that's 13.07. So this is CU, right? And CD is 0. So all we need to do is plug in these numbers. So this is 13.7 minus 0 divided by the price of the stock, which is $27 per share, multiplied with the up factor, which is 1.41, minus the down factor, which is 0.71. And that's going to give you the number of shares. So you would have to keep a 0.6915 share to create that perfect hedge. Students online, everyone clear? So this is a theoretical aspect to it. Now, something important to understand is in practical sense. For example, if you are an analyst and if you are trying to assess the number of shares you should keep in your portfolio, you won't be given the up factor and the down factor. Where is the skill that is to be brought in this scenario? How would it differentiate whether Hassan is a better, you know, analyst, or Robert is a better analyst, or Akshay is a better analyst, or Chandra is a better analyst? It's going to be trying to estimate what is the likelihood of the up factor or the down factor based on different scenarios. And that would differentiate. For example, if I arbitrarily kept too much of up factor, you know, and I don't make too much of, you know, what could be the risk to the underlying security, then I may not be having the right number of stocks in my portfolio. That is the ultimate implication of these calculations. So, this is the starting point. Your real skill will come to read the news and assess what's the risks to the company. What is the likelihood that the stock will go up? And by what factor? For example, Apple. If Apple stock today is $100, how much are you projecting the stock will be in January 15th? Would you think it's going to be 90 or 85? I said, let's take a scenario. Let's say today Apple stock is at $100. On January 15, 2016, by what factor up or down the stock is likely to go up or down? What is your assessment? Yes, I mean the factor of up 1.8. Yeah. It's going to go up by 80%. 20%. 20% would be fairly okay. 4%. You're not placing too much of the fact that they have come out with a new phone. They'll probably do well in holiday season. So that's fine. I mean, that's how analysts will differ. For example, if I were to say, I'll say it may go up by 10% or 15%. Factor of 15%. So that's fine. Everybody is going to be different, and that's how I'm just giving how you should be interpreting these formulas. They're not written in stone, because the formula is written in stone, but the variables are going to come from your assessment.
So 0.6915,
A theoretical number. Don't take it as a, like you are not going to be able to buy a 0.6915 share. Nobody's going to give you a, 3/4 of a share. They'll probably give you one share at least, right? So what that means is you create a portfolio of 69 shares or 690 shares or 6,900 shares. You see what I'm saying? So this is to be multiplied for those many number of shares in the position that you want to hold. So this is the theoretical working of it. You got to understand the practical implications for this. All right, students online. So this is how you have to try and use this for practical implications. Okay, when we've created a riskless portfolio, the payoffs at call's expiration is $13.26. So irrespective of whether it goes up or down, your payoff will be $13.26. Now, how does that happen? Look at this. Let's say the current stock price is $27. Ending up stock price is, which is the factor of up factor. This is $38.07, which we've already calculated. Ending up stock value, N multiplied with the price multiplied with the up factor. I mean, I can calculate that in the Excel worksheet. All right, students online, can you view the Excel worksheet? So let's do this again. Is equal to $27. Okay, So in this case, if we are looking at the case 1, that is up by a factor of 1.41. Then in this case, your ending stock up price will be, just a minute, ending up stock price is price multiplied by the factor. So in this case is 27 multiplied by 1.41, which is 38.07. Ending up stock value and remember you have 0.6915, n is equal to 0.6915. This is the amount of shares you have. Okay, not one share, but 0.6915. Yes. Sure.
So if we had 1,000 shares of Microsoft, in order to hedge the portfolio, if we hedged it,
You would have to get 690. Yes.
so 1.41%.
Yeah. Well, not 1.41. By factor of 1.41, that is 41%. Yes. So this is number of shares, which is 0.6915 multiplied with the price of the stock, which is 27, multiplied with the up factor, which is 1.41. So this is going to be $26.33. This is the ending up stock value. And then what we have is option payoff. Which is the maximum of 0 or the price up minus X, which we have already calculated. That was 13.07. So the portfolio net payoff is going to be the ending up stock value minus the option payoff, which is this 130, which is 13.26. Okay, so this is case 1. Now let's look at case 2. Just so case 2 is down by a factor of 0.771. Okay. So in this case, the ending down stock price is going to be the current stock price, which is 27, multiplied with 0.71. That's $19.17. Okay. And the next thing is ending down stock value, and that is NPD, so N in this case is 0.6915. I mean, you can always put them in a cell and reference so that you don't have to type again and again. But since I want to solve this with you guys, so I'm just showing step by step. Prices in this case 27, or we can simply take 19.17. I mean, because the same thing. But let's follow the formula. 27 multiplied with 0.71. So this is $13 and roughly 26 cents. Okay, and then the option payoff in this case is what? $0, right? From the previous calculation. So then portfolio net payoff is 13.26 minus 0. That's equal to 13.26. So you've created a perfect hedge. So either case, now you're not worried. If it goes up, you will still make 13.26. If it goes down, you will still make 13.26. So you got a perfect hedge. So this is the same thing, what we've done right now. What about the riskless payoffs earn the risk-free rate of return? Discount at risk-free rate compounded daily. Present value of the riskless portfolio, will give you the value of the portfolio. So in this case, value of the portfolio will be the payoff divided by 1 plus R raised to the power T. That is to get the present value, right? This is the formula, right? Present value is equal to future value divided by 1 plus R raised to the power T. This is the formula. Payoff is the future value, and then this is 1 plus R divided by 365 because it's on a daily basis. The raised to the power T is going to be 365 multiplied by T. For 6 months, it will be half a year, 6 months, which is close to what, 182 days. So that would be this formula, 13.26, which is the payoff we just calculated, divided by 1 plus R. This is the R raised to the power T, and that would be 12.87. So this is the value of the portfolio today by discounting. Okay, students online? All right, so we're making good progress. The value of the call option, because the portfolio is riskless, value of this portfolio will be the present value of the riskless payoff. By definition, the value of portfolio is number of stocks in a portfolio multiplied by the price of each stock minus the value of the call option. Equating these and rearranging, we get the value of the call, which is number of stocks in a portfolio multiplied by its price, that is the current price, minus the present value of the riskless payoff. So we can calculate that, and this would be 0.6915 multiplied by the current price, which is $27, minus the payoff, which we calculated, that's 13.26, divided by, and this one is a little tricky, if you need to calculate and get the same answer, first calculate this part and then add it to 1. Don't do 1.06 divided by 365, you'll get a wrong answer. Raised to the power 365, because the formula is what? 1 plus R. So you have to first calculate the R and then add it to 1. okay, because you are trying to standardize it based on the number of times compounding. So this will be 18.65 because that's going to be, you know, this 0.6915 multiplied by 27, and that minus 12.87. So this is $5.80. So this is 5.81 if no rounding is done in any intermediate step. So this will be the value of the call option. All right, everyone clear on this?
That's what in theory you would buy the call option.
Yes, this is a way to assess the fair value of the call option.
Paying a little more time premium.
Yes. There's another way which I'll show you following this, and that's the Black-Scholes. Two people, I think they won the Nobel Prize for coming up with that formula, and that is used a lot in industry because you can get ready numbers, you know, from various sources, and that you can plug in then to get the fair value of the call option. But this is one way to do it. Multi-period binomial pricing, we won't really go into the schematics of it, you know, the calculation, but you should know that, you know, it probably can be on a continuous basis, and computers can really help you calculate a binomial pricing. If you divided time into smaller periods, for example, not taking, you know, 3 months. Let's say you divide the up and down even further. So after, let's say, for example, the first period, it went by a factor of 1.71, but let's say you're projecting that if it went by that factor, again, two possibilities are possible in the second quarter of the year. It may go up by a factor of 1.21, or it may fall by a factor of 0. Let's say 6. And then these two again could have further possibilities. So you see, it's like tree, the branches of a tree. So you have a binomial possibility for each aspect of this tree.
A lot of times, prior to companies' earnings coming out, you'll see like on Bloomberg or whatever, they'll say, you know, options pricing in 12% move either way.
Yeah.
On the stock with the earnings.
That is one way. Yeah, that is one way to also price the stock price. That is, you know, if you have the option pricing, which the value of the option pricing will indicate whether there's risk to the stock price or not. So I'm not going to go into, you know, the practical workings of multi-period binomial pricing because I don't want to you know, confuse you. But you should know that in practical scenario you would have multi-period binomial pricing as well. It doesn't stop at one pricing. It could be further deviate. You know, for example, this is November. You might say, well, there are two possibilities for December, and if it goes up, there'll be further two possibilities for January, and then for February there'll be 4 possibilities. For, you know, so they are basically increasing by a factor of 2 each time. So as period gets smaller, the binomial option price converges to the Black-Scholes price, which we will discuss in the later slide, which is a better way to assess the fair value. Now, replicating portfolio From the previous slide, we have seen that the value of the call option is equal to the number of stocks multiplied by the price of each stock minus the payoff divided by 1 plus the risk-free rate divided by the number of days that you are taking the loan for, just to get the present value of the call option. The right side of the equation is the same as creating a portfolio by buying N shares of stock and borrowing an amount equal to present value of hedge portfolio's riskless payoff, which must be repaid. So basically what you're saying is you're trying to borrow funds to finance this investment, and that borrowing would happen at the risk-free rate. The payoff of the replicating portfolio are the same as options payoff. So let's take an example. Hopefully this will help you understand. The amount borrowed is let me see if there's a okay. So the amount borrowed is present value of the payoff, which is $12.87, which we had calculated in the previous slide. There you go. This is the present value. 13.26 divided by 1 plus R raised to the power T. So that's the payoff, present value of the payoff. Repayment due to borrowing this amount is going to be $12.87 multiplied by 1 plus R raised to the power T, because that's the future value of this present borrowing. You've borrowed this fund, you would have to return it at a future time, and that is following the future value formula, which is present value multiplied by 1 plus R raised to the power T. So in this case, present value is this 12.87, the amount that you borrowed, multiplied with 1 plus R. So you got 6%, money at 6% for 182 days on a daily interest pay rate. Let me show you how to calculate that. All right, students online, can you view the Excel worksheet? All right, so you got borrow amount, which is $12.87, and then the repayment would be based on your interest, that is 6%, or 0.06. So, and the number of days you've borrowed it for are 6 months. That's going to be it's 182 days, 182, I'll just round off to 182 days. Okay. Or I can leave it, as it was before. And your repayment would be the present value, which is 12.87, and then 1 plus R, which is 0.06 divided by 365, and that raised to the power t, which is going to be 182 these days. And that's going to be $13.26 odd cents here, which is on the PowerPoint. Okay. Notice that this is the same as the payoff of the hedged portfolio. So, this protects your total investment. So you're not paying anything out of your pocket in case you have to borrow funds. So the implication here is you've not used your money. In worst case scenario, if you don't make anything, you'll be at zero basis. But if you make money, you pay off 13.26 and then you keep that extra funds. That's the implication of this. So you're not used your money here. Students online, everyone clear on this? So replicating portfolio net payoffs. So again, looking at the two scenarios, and in this case, you start with the number of shares multiplied with the price plus the up factor, which is 26.33. Repayment of borrowing 13.26. Net payoff is 13.07. If it's down, the number of stocks multiplied with the down factor multiplied with the stock price, that's equal to 13.26. The repayment for borrowing is 13.26, which is the interest plus the principal that you borrowed. So in this case, net portfolio payoff is 0. So you see what's happening here? Worst case scenario, you will end up with 0 balance because you have financed the deal. If the stock goes down, worst case scenario, you will lose 0. You will not have lost anything. All right, students online, can you hear me? We had an intermittent cutoff in the internet connection here. Notice that replicating portfolios payoff exactly equals those of the option. So replicating portfolio arbitrage, the payoffs of the replicating portfolio exactly equal those of the call option. The cost of replicating portfolio is given here, the number of shares, the price minus amount borrowed, and that is the cost of replicating portfolio, which is $5.80. This is the value of the call option that we had calculated. If the call option price is not the same as the cost of replicating portfolio, then there will be an opportunity for arbitrage. That is, you can step into, buy or sell an option which is there with a difference. For example, if this is the fair value of the call option and it's selling at, let's say, 540, then you can buy it. And if, let's say, it's selling at 590, then you can sell it. So arbitrage example, suppose the option sells for $6. You can write the option, receive $6, create a replicating portfolio for 580, netting 20 cents. Any money is good money. If you're not using your own money, or if you are, not investing, you invested none of your own money, right? You have no risk. You have cash of 20 cents in your pocket. What other things do you want? What else do you want? Is there a better scenario? So learn this trick and use it and make money. Arbitrage and equilibrium price, if you could make a sure arbitrage profit, you would want to repeat it, and so would other investors. That's the reason why you'd find, very few opportunities for arbitrage, because you're not the only smart person there. There'll be other people also looking for it. And if you do it, the other person will be very suspicious. Hey, why is he writing so many call options? Let me calculate and see. And then they'll also start writing, and then because of competition, that difference will go away. With so many trying to write or sell option, the extra supply would drive the option price down until it reaches the fair value, which is 580, and there would be no more arbitrage profits available. So then you'll have to find something else where you can find the arbitrage. For the opposite would occur if the option sold for less than 580. So it's a continuous, process. Now we come to Black-Scholes option pricing model. Again, a very important aspect of finance. I mean, it's as important as time value of money. I mean, there's time value of money for the basic of finance. If you step into advanced finance, then the Black-Scholes is something as important. And this gives you, again, an assessment of the fair value of an option. So there are some assumptions for Black-Scholes option pricing. One is that the stock underlying the call option provides no dividend. So you're not adding dividends to the stock price during the call option's life. There are no transaction costs for the sale purchase of either the stock or the option. Risk-free rate is known and constant during the option's life, just to make assumptions simple. Security buyers may borrow any fraction of purchase price at the short-term risk-free rate. So there are no hindrance to borrow funds. You are able to get at the risk-free rate. No penalty for short selling, and sellers receive immediate full cash proceeds at today's price. Call options can be exercised only on its expiration date. Security trading, so this would be what sort of an option if it can be exercised only on the expiration date? Yeah, but I'm asking European option. That would be a European option, but that's an assumption. The idea is, because if you have 3 months worth of time, then you're trying to make your assumptions easier to calculate. Security trading takes place in continuous time, and stock price moves randomly in continuous time. So it's a very simple formula. This is the formula, right? Students online? It's a very simple formula. Yeah, see, everybody's agreeing. It's a very simple formula. All right, so we got to go step by step to calculate this, and you need to calculate the D1 and D2 first, and then you can plug in the values into the value of the call option formula. Now, let me explain what the variables are. VC is the current value of the call option. This should be the fair value to calculate the fair value. P is the current price of the underlying stock. This P here, this P here. ND1, which is going to be the probability that a deviation less than D1 will occur in a standard normal distribution. Thus, ND1 and D2, so these are the standard normal distribution probabilities of these values. They represent area under a standard normal distribution function. That is, what is the likelihood of D1 and D2 to occur? Okay? Everybody thought, people sitting and trading for the options, they are just getting millions of dollars for nothing. I mean, you have to put in hard work to get theirs. So, but I'll try to make it as simple as possible. Don't worry, this may look very complicated, but we'll just go step by step. I'll show you an actual example. X is the strike price, which we already know. This is the strike price of the option. E is an estimate. It's a constant value of 2.7183. It's always that. RF would be the risk-free interest rate. This RF here, at which you can borrow. T is the time until the option expires. This is the option period, the T, this T as well. ln P by X is the natural logarithm of P divided by X. P is the current price of the underlying stock, and X is the strike price. And then sigma is the standard deviation of the rate of the return of the stock. Okay, so a lot of variables there, and they are listed on page 320 of your textbook in case you'd like to follow them again. And let me show you an example now, and we'll go step by step. Hopefully we'll get a right answer. So let's assume that these values are given to us. Price is 27. Let me open up the PowerPoint page so I can type them up in Excel. And then X is the strike price. RF is 6%, which is the risk-free interest rate. T is 6 months, that's half a year. And sigma is the standard deviation of the price of the stock. That is a deviation that's noted in the price of the stock. That's 49% or 0.49. So let me open up Excel and follow this step by step very closely. All right, students online, can you all view the Excel worksheet? So what we'll do is we'll first calculate D1, and I'm going to break up, the formula. The first part is natural logarithm of P divided by X. So let me just first put the values here, P, X, and then we need E, then we need RF, which is a risk-free rate, time, and then standard deviation. So price is 27, X is 25, E is 2.7183. The risk-free rate is 0.06, which is 6%. Time is 0.5 years, which is going to be 0.5, and standard deviation is 0.49. Okay, so let me calculate D1. D1 starts with ln, which is returns the natural logarithm of a number, and that is going to be price divided by X, 27 divided by X. So that's the number here. And then the next part is plus RF plus sigma square divided by 2, and then all of that is multiplied with 10. I'm sorry, time. So RF is going to be this one, 0.06, and this is going to be sigma square divided by 2, and the entire thing will be multiplied with T. Okay. So if I add, and then there's a denominator also, which is going to be sigma. This is going to be sigma, and then multiplied with standard deviation of T, which is going to be this, raised to the power 0.5, which is half. Okay, so this is going to be this plus this, and this is the denominator. So this would be this divided by this. Alright, so far so good. We have the first answer, which is exactly as the PowerPoint, so I'm glad. Let me reduce the number of decimal points to match exactly as in the PowerPoint. So, it's always okay to break it up because you're not making any mistakes. That's fine. D2, and as you become more comfortable, you can just add all of them. D2 is now D1 minus sigma multiplied by square root of T. So D1 is this number here minus sigma, which is 49, multiplied. Actually, we have done that, so I can just take that number here. Yeah, this one here. I can take this number. So it's 13.55, which is now exactly as in the PowerPoint. So my numbers are correct. Okay, so these are my numbers. Because you need to add precision to your calculator. It's showing decimal at 2. So add, make changes to show at 4. So it'll give you that precision. Alright, so that's done. D2 is calculated. Now we need to calculate the normal distribution. Normal distribution are again a function in Excel. So use NORMS. This is norms dist, and then take that value. So this is the probability value, which is 0.6850. And I can just, that's exactly as in the PowerPoint. And then again the same thing for the other one, norms dist, and that is for this value. So these are the standard normal distributions. Okay. So now we have to bring all of this together in the third and the final formula, which is for the value of the current, the current value of the call option, and this is VC, and that is price. multiplied with normal distribution of B1, which is this one here, minus, so let me just break it up again, and this is minus XE raised to the power risk-free rate time. So this is going to be X is 25 multiplied with E. E is this 2.7183 raised to the power minus risk-free rate times T minus the risk-free rate times T, which is 24.61, and that multiplied with the normal distribution of B2. So before that, let me just do the first part. So this multiplied with 13.47. So this is going to be 18 minus this, which is 5.05. Yay, we got the right answer. And that we can just pass it here. And this is the fair value of your call option, which is exactly what we have in the PowerPoint. And what I'm going to do is I'm going to save it and upload it so you can keep it. So now you have a working worksheet for a Black-Scholes model. Wall Street bankers would charge you thousands of dollars for that, you know. I'm giving away for free just because I love my students so much. All right, let me save it someplace. I can put them right after the class. Now the good thing is you got a working model. So for example, you know, if the price changes to 28, all you have to do is just change from 27 to 28. It'll update. Now you got the fair value of the call option to 5.76. So you know, you can play around with numbers. 36, it should be 12.38. And let's say if the risk-free rate, if the Fed increases the risk-free rate from 6% now to 8%. So all the scenarios you can change, and you know, you can play around with. So this is let me just put back the old numbers. There you go. So that's why I love working with Excel, because it gives you a working. Once you've made your worksheet, now you can play around with numbers. You don't have to calculate over and over again. This is done. Now you can change various scenarios. For example, if the standard deviation, that is the risk to the portfolio, the stock increases, all you have to do is just change the standard deviation to, let's say, 60, and see the value of the call option has changed. And this also helps you understand what impacts the numbers. Now, one thing that's interesting, it's a good thing that I was playing around with standard deviation. Look at the value of the call option. Earlier, what was the standard deviation? 0.49. What was the value of the 5.6. And if I increase the standard deviation to 60, I mean, now the risk has increased, but the value of the option has also increased. Why is that? Yeah, it's riskier. It's riskier, but why do you think it has increased? That's the right word. There's more potential for the change in the pricing of the stock. If a stock is very docile, it doesn't fluctuate too much, there is no possibility to go up or down. For example, again, in case of a baseball player, if he or she always goes 50, I don't know, I'm not a baseball fan, but I'm just giving a number. Like, I don't know how do they play? What's the number for a player? But how would a score be there for a player? What would be a batting average range? 300. Let's say in one match, will they make 300? Okay. Let's say if a player would always make 300. So there is no wiggle room for up or down. But let's say the player in one game makes 0, another game makes 300, then another game makes 100. So there's a lot of volatility. So the higher the standard deviation, there is more wiggle room for the potential for the numbers that you have optioned for to make. I mean, the betting in the games also follow option pricing. All the fantasy football and those kind of things. You could use an option pricing model to play a fantasy football. I'm not that I'm projecting or not that I'm promoting that, but I've read papers where they use the Black-Scholes option pricing model to predict what are the likelihoods for the scores or the scoring patterns for teams. So this, I hope everyone would or should really memorize if you have to, because this is, after time value of money, this is the next most important topic in finance. And fortunately, the two people the Black and Scholes, they were awarded the Nobel Prize. I think so, if I'm not mistaken. So this is the calculations, same thing. And this is for the normal distribution calculation. And this is the final value that we got on our worksheet, which is $5.06. So what impact do the following parameters have on a call option value? Current stock price. Call option value increases as the current stock price increases. Strike price. Why would the call option value increase as the current stock price increase? Because now you would have a more chance of making money from exercising the option if you were to buy this option as the price is going up. Strike price, as the exercise price increases, a call option value decreases, which is completely the opposite. If the strike price goes up, the underlying stock price may not reach that value. So the value of this call option would decrease. Option period, as the expiration date is lengthened, a call option value increases. Remember, we discussed you get more chance of being in the money. Risk-free rate, call option value tends to increase as the risk-free rate increases, reduces the present value of the exercise price. Because if the risk-free rate increases, what's going to happen to the price of the present value of the exercise price? It'll reduce. Stock variance, option value increases with variance of the underlying stock. More chance of becoming in the money. Put option. A put option gives its holder the right to sell a share of stock at a specified stock on or before a particular date. So if you are worried about your portfolio and you're thinking that, you know, as time passes, the value of the stock in your stocks in your portfolio are likely to go down because economic conditions may not be conducive, you may want to engage in a put option, which gives you the right to sell given, you know, if the stock prices go down. So this is how it will work. Portfolio 1 put option, you'll have the share of stock. In portfolio 2 call option, value, that will be the present value of the exercise price. And these are just, you know, again, the two scenarios, what you'll do in which case, if it were to happen. You know, this is the price of the stock. These are, you know, in case you are able to be in the money. This is the exercise price, which is less than the stock price. So you are able to sell at a higher price than the price is in the market. On the other hand, your value is 0 in case the market price is over the exercise price. So again, you know, in case of call, it's the reverse, and cash positions. And then finally, put call parity, that is, you know, you can portfolio payoff are equal, so portfolio values also must be equal. In this case, put plus stock equals call plus the present value of the exercise price. You know, simple as that. And this is the graphic, the numerical representation of these relationships. So that brings us to end of chapter 8, and without, you know, again going into too much of the nitty-gritties of, you know, these formulas, what I want you to take from this chapter is the concept of option, when you'll be in the money and when you'll be out of the money, and also understanding how to calculate the fair value of an option, especially by using Black-Scholes, because that's something which is used still a lot. I mean, I think they came with that formula in the 1970s, and it's still widely used. I mean, let me see if I can pull up some. Yeah, so they came with this formula in 73, and if I'm not mistaken, one of them got the Nobel Prize because the other person had died. So I think in the Nobel Prize award, you have to be alive to receive the award. So yeah, Black-Scholes for calculating the premium of an option was introduced in 73 in a paper entitled The Pricing of Option and Corporate Liabilities, published in